On June 17, 2025, Hyatt closed a deal to buy Playa Hotels and Resorts for roughly $2.6 billion, picking up 15 all-inclusive resorts across Mexico, the Dominican Republic, and Jamaica. 13 days later, Hyatt announced it was selling the actual real estate, the buildings, the beachfront land, all of it for $2 billion. Not eventually. Not after a rough quarter forced its hand. 13 days. It kept 50-year management contracts on almost every property it had just sold. By the end of this video, you'll understand why a company would spend billions of dollars buying hotels specifically so it could immediately give the buildings away, and why that isn't a strange one-off deal. It's Hyatt's entire strategy, just playing out in fast motion for once instead of taking a decade to unfold the way it usually does. Walk into almost any Hyatt property and none of this is visible. There's no sign in the lobby explaining who actually owns the building versus who just runs it. The person checking you in works for Hyatt in every way that matters to you: the uniform, the training, the brand voice, and in a lot of cases works for a real estate owner you've never heard of in every way that matters on paper. That gap between what a hotel looks like and who actually owns the risk sitting underneath it is where this entire story lives. Ask most people what Hyatt is, and you'll get the obvious answer: a hotel company. Regency towers in city centers, all-inclusive resorts on Caribbean beaches, a rewards app on your phone, a front desk that upgrades you if you're lucky. Walk into a Hyatt Regency and that story holds up completely. It's a real hotel, with real employees, real rooms, and a real nightly rate. Compared to Marriott or Hilton, Hyatt is also honestly the smaller player, and the gap isn't close. Marriott ended 2025 with nearly 10,000 properties and almost 1.8 million rooms worldwide. Hilton passed 9,000 operating hotels the same year. Hyatt, by comparison, runs a bit over 1,450 hotels and resorts roughly a sixth the footprint of either giant. On the surface, it looks like a mid-sized hotel chain quietly trying to keep up with two much bigger rivals. That's the version of Hyatt you can see from the lobby. It's not the version that explains why investors care about this company, because increasingly, Hyatt doesn't want to own the hotel you're standing in at all. For most of its nearly 70 years, the company was founded by the Pritzker family in 1957. Starting with a single motel near the Los Angeles airport, Hyatt built its reputation the traditional way, developing and owning striking, architecturally ambitious hotels itself. That history is part of why the shift away from ownership feels so counterintuitive. This is a company whose brand was built on the buildings, now actively trying to own as few of them as possible. Here's the shift, and it's been building for almost a decade. Around 2016, roughly 40% of Hyatt's earnings came from what the industry calls asset-light operations fees, essentially, as opposed to owning and operating real estate directly. By early 2026, that number had climbed past 80%, and Hyatt's CEO has said the company expects to hit 90% asset-light earnings this year. 90%. That's not a side hustle bolted onto a hotel company. That's a near total inversion of what the business actually is. Marriott and Hilton made this same pivot years earlier. Hilton in particular spun off almost all of its owned real estate more than a decade ago, which is part of why Hyatt has spent the past several years playing catch-up, selling off owned hotels one portfolio at a time to close the gap. The logic is almost embarrassingly simple once you see it. Owning a hotel means owning a $50 million building that needs a new roof, a renovated lobby, and a fresh set of mattresses every few years, whether or not travel demand cooperates. It means carrying the building on your balance sheet through every recession, every regional downturn, every awkward stretch where occupancy dips and the mortgage doesn't. It means being on the hook when a hurricane closes a resort for 6 months, or when a market gets overbuilt and every hotel within a mile is discounting rooms to fill beds. Managing a hotel or simply licensing your name to one means none of that. Someone else, a real estate investor, a pension fund, a sovereign wealth fund, puts up the capital and takes the property risk. Hyatt shows up with the brand, the reservation system, the loyalty program, and a management team, and collects a fee on top, largely regardless of who owns the roof. So, what does that fee actually look like? It's rarely one number. A typical Hyatt management agreement includes a base fee, commonly somewhere in the neighborhood of 2 to 4% of a hotel's total revenue, paid whether the property has a great year or a mediocre one. Layer on top of that an incentive fee, often somewhere around 10 to 20% of the hotel's profit once it clears a return threshold set for the owner, so Hyatt's upside grows when the property actually performs well. For hotels that carry the Hyatt name without full management franchise arrangements, there's a separate franchise fee, frequently landing higher, sometimes 5 to 7% of revenue, since the owner is running day-to-day operations themselves and paying mainly for the brand and the booking engine. Put real numbers on it, and the appeal becomes obvious. Take a mid-sized hotel doing, say, $40 million in annual revenue. A 3% base fee alone is worth roughly $1.2 million a year to Hyatt, collected whether that hotel runs at 50% occupancy or 95%, whether the owner's mortgage is comfortable or underwater. Add an incentive fee once the property clears its return threshold. And Hyatt's income on that single building keeps climbing even though Hyatt didn't put a dollar of construction capital into it and doesn't carry it on its balance sheet. Multiply that across a portfolio of more than 1,450 hotels and all-inclusive resorts spread across over 80 countries, and you start to see why a management contract is worth more to Hyatt than the building it's attached to. That geographic spread matters too, because it means Hyatt's fee income isn't leaning on any single economy. Roughly 44% of its business runs through the United States, but the rest is spread across the Americas outside the US. Asia Pacific, Europe, Greater China, and the Middle East and Africa, a mix that gives Hyatt some insulation if any one region has a rough travel year, the same way a diversified investment portfolio rides out a bad quarter in one sector because the others are having a fine one. In Hyatt's own 2025 numbers, base fees made up about 37% of total gross fees. Incentive fees another 23%, franchise and related revenue fees roughly 23%, and the remainder came from fees that aren't tied to room revenue at all. All told, Hyatt pulled in something just over $1.2 billion in gross fees in 2025 against an adjusted operating profit for the whole company of a bit more than $1 billion. The fees aren't a nice supplement to the hotel business. For most of the company's actual profit, the fees are the business. Which brings us back to Playa. Once you understand the fee model, the 13-day turnaround stops looking strange and starts looking inevitable. Hyatt paid roughly $2.6 billion for Playa, absorbing the company's debt and obligations along with its resorts. Almost immediately, it agreed to sell the entire real estate portfolio to Tortuga Resorts, a joint venture backed by KSL Capital Partners, for $2 billion, with up to another $143 million available if the properties hit certain performance targets, plus $200 million of preferred equity Hyatt kept in the new venture. In exchange, Hyatt locked in 50-year management agreements on almost the entire portfolio. It's worth asking why a real estate investor like Tortuga would want the other half of this trade. From their side, a 50-year management contract with a globally recognized operator already attached is close to the ideal asset, predictable, professionally run, and backed by a brand that comes with its own demand engine without Tortuga needing to build any hospitality expertise of its own. Hyatt gets to shed the building and the risk that comes with it. Tortuga gets a bond like real estate holding with a trusted operator already locked in. Both sides walk away with exactly the kind of risk they actually wanted. By the time the deal fully closed at the end of 2025, Hyatt's actual net cost for what it kept the fee-generating management business, stripped of the real estate, worked out to somewhere around $555 million, roughly a fifth of what the headline purchase price suggested. Hyatt's own CEO put it plainly, the sale transforms the acquisition of Playa Hotels and Resorts into a fully asset-light transaction. Translated out of earnings call language, that means the buildings were never really the asset Hyatt wanted. The 50-year contract was. That pattern, buy the relationship, sell the real estate, keep the paper, is the entire growth engine now. And it needs one more piece to actually work. A reason for owners to trust Hyatt with their property for decades at a time instead of hiring a cheaper operator or running it themselves. That reason is World of Hyatt. The loyalty program has grown to roughly 63 million members, up about 19% in a single year, which sounds respectable but not overwhelming next to giants like Marriott Bonvoy or Hilton Honors. Here's the more interesting number. Hyatt claims something like 43% more loyalty members per hotel than its closest competitor. Fewer total members, packed into a much smaller number of properties, means each individual hotel is pulling in a disproportionate amount of loyal, repeat, direct booking traffic. And that traffic behaves differently. Hyatt's own numbers show World of Hyatt members stay 62% more often and spend 93% more than non-members, and the number of members staying more than 50 nights a year climbed another 13% in 2025 alone. For a property owner deciding who gets to run their building for the next half-century, that density is the pitch. Fewer strangers booking through a discount travel site, more return guests who chose Hyatt on purpose, often paying with a co-branded Chase credit card that quietly funnels more members into the program without Hyatt spending a cent on traditional acquisition. A loyal guest base means more stable, more predictable revenue for the owner, which is exactly the kind of promise that makes someone comfortable signing a management contract that will outlive most of the people negotiating it. That trust is also what's funding Hyatt's next phase of growth, and it's happening almost entirely through other people's money. Before we get to that, it's worth noticing that hotels aren't even the whole fee story anymore. Tucked inside Hyatt's corporate structure are a handful of businesses that never put a single guest in a room and still collect a fee every time you plan a trip. AUG Vacations, the tour operator arm Hyatt picked up when it acquired Apple Leisure Group, packages flights and all-inclusive stays and takes a cut on the way. Tricept Solutions runs booking technology that other travel companies license, earning Hyatt a fee on bookings it doesn't even make itself. Unlimited Vacation Club sells a membership that works something like a timeshare without the deed, charging recurring dues for discounted access to Hyatt's resort network revenue that shows up every year regardless of whether that member actually travels. Mr. and Mrs. Smith curates boutique hotel recommendations and takes a booking fee when you act on them. None of these show up when you picture a hotel company. All of them are the exact same instinct as the hotel management fee, just aimed at a different part of the trip get paid for being the trusted middleman, not for owning the thing being sold. In 2025, Hyatt launched 3 new lower-cost brands unscripted by Hyatt, Hyatt Studios, and Hyatt Select aimed at markets and price points the company barely touched before. Those 3 brands alone accounted for nearly 2/3 of all new U.S. hotel signings that year. Hyatt ended 2025 with a development pipeline of roughly 148,000 rooms, equal to about 40% of its entire existing room base, and is guiding towards 6 to 7% net rooms growth in 2026. Almost none of that capital is Hyatt's. Franchisees and property developers are the ones breaking ground and financing construction more than 80% of the U.S. Pipeline alone is entirely new construction, not conversions of existing buildings. Hyatt supplies the brand, the systems, and the loyalty engine, and its reward for underwriting none of the construction risk is a multi-decade fee stream on every single room that opens. None of this is as easy to copy as it sounds, even though the underlying mechanics are simple once you see them. A 50-year management contract doesn't get signed on a handshake, and owner is trusting that Hyatt's brand will still be filling rooms reliably decades from now, and that trust is built on exactly the kind of long track record and loyalty engagement data a brand new entrant simply doesn't have. You can't shortcut 60 plus years of operating history or manufacture 63 million loyalty members overnight. It's a large part of why global hotel management has consolidated around a small handful of real players, Marriott, Hilton, and a second tier that includes Hyatt, IT, and Accor, rather than fragmenting into dozens of asset-light challengers, all offering owners the same pitch. The barrier isn't the paperwork, it's the decades it takes to become a name an owner is willing to bet 50 years on. None of this makes Hyatt untouchable, and the same transformation that's building the fee engine is creating real blind spots along the way. The most immediate one shows up on the headline numbers, because Hyatt has been buying and rapidly reselling entire portfolios. Absorbing transaction costs and booking real estate impairments as part of the shuffle, its reported GAAP profit has been genuinely volatile through this stretch, sometimes negative, even while the underlying fee business and adjusted earnings keep climbing. That's a real cost of the strategy, not just an accounting footnote. And it means casual readers of Hyatt's headline profit numbers over the past couple of years could easily have walked away with the wrong impression of how the company is actually doing. A hotel company that looks unprofitable on paper while its real recurring fee income grows underneath is a confusing story to tell the market, and Hyatt has had to keep re-explaining it. Earnings call after earnings call. There's also a dependency baked into the whole flywheel that's easy to miss. The Playa maneuver only works because a buyer like Tortuga existed, willing to pay a fair price for beachfront real estate and sign onto a 50-year contract. Hyatt has said it wants to recycle at least another $2 billion out of owned real estate by the end of 2027. That plan assumes a steady supply of institutional capital that wants exactly this kind of long-dated, operator-backed real estate, which has been true for the last few years, but isn't guaranteed to stay true. Real estate buyers like Tortuga are often financing these purchases partly with debt, which means the price they're willing to pay and their appetite to do more deals shifts with the cost of borrowing. If real estate capital gets more expensive, or buyers get pickier, or valuations soften, that recycling engine slows down, and Hyatt's ability to fund its next wave of low capital growth slows right along with it. Then there's the exposure that comes from where Hyatt has chosen to concentrate. The company has leaned hard into luxury, lifestyle, and all-inclusive leisure travel, a strategy that's paying off handsomely right now, with luxury brand leisure revenue growing especially fast, and Hyatt riding a genuine tailwind heading into events like the 2026 World Cup, boosting demand across host cities. But a portfolio this concentrated in the upper end of leisure travel is also a portfolio that's more exposed if affluent travelers pull back at the same time, and a mega event tailwind is, by definition, temporary. It boosts the numbers for a year, and then it's gone. The same way a wave of good luck always is. And the scale gap from the top of this video hasn't closed. Marriott's pipeline, alone the hotels it has under construction or signed but not yet open, is larger than Hyatt's entire existing portfolio. More total properties means more negotiating leverage with booking platforms, more corporate travel contracts, and a loyalty network with more sheer reach, no matter how loyal Hyatt's members are per property. Which brings it back to those 13 days in the summer of 2025. It's easy to read the Playa deal as an oddly fast flip, buy a hotel company, sell the hotels almost before the ink dries, but that's not a strange exception inside Hyatt's business. It's the clearest, most compressed example of what the company has been quietly doing for the better part of a decade. One property and one management contract at a time, patiently moving from 40% asset light to a target of 90. Every renovation Hyatt doesn't have to fund, every recession it doesn't have to weather as a landlord, every hurricane season it watches from a distance instead of absorbing directly onto its balance sheet, all of it is the same trade playing out again and again, just usually spread across years instead of compressed into less than 2 weeks. Hyatt was never really in the business of owning buildings you sleep in. It's in the business of being the name on a 50-year contract, collecting a fee on somebody else's real estate, whether that real estate took 10 years to arrange or 13 days. The lobby, the loyalty app, the fresh towels folded on the end of the bed, all of that is the delivery mechanism. The contract is the business.